Our Groupon IPO roundtable coming up. Also joining us is Bloomberg contributor Paul Kedrosky from San Diego and Ken Sena, a director in equity research group at Evercore Partners. He still says Groupon has a shot at success, but seems somewhat skeptical. He joins us now from New York. So Ken, let's start with you. Sure. What do you know about how much investor demand there is out there, really?
Well, I think Cory mentioned it, that there really isn't a lot of float. And so, there are already investors who are at the table. I think they'll probably increase their stake as part of this raise. And I think that, I think for the investors who have a shot at being in it, I think there is some decent interest. I think there are questions, I think, from a fundamental standpoint that they have. And I'm not sure that they're getting all their questions answered, but I do feel that there's definitely strong interest, at least from what I'm hearing.
Now, Paul, we're hearing about people fighting to get into this IPO. Is it because they just want to short Groupon, or do they want to be part of this company long term?
Oh, I can't imagine who those people are that want to be in it as a long-term project. Just like I can't imagine, quite honestly, who these people are who are still waiting till now to go to a roadshow to get their questions answered. Quite honestly, there's an old saying in the technology industry that if you're not paying for something, you're the product. These people attending the roadshow are the product. They're part of the marketing exercise for the Groupon IPO. And, kudos to them. Have a nice time and go. But the idea that 4 days away from the IPO, you haven't made a decision yet about allocation is absurd.
Cory, going off what Paul said right there, how does the Groupon IPO differ from other hotly anticipated tech IPOs that we've seen over the last decade?
Well, I've also attended a lot of these. Paul's comments are on the money. There is a free lunch involved, though. I heard it was pretty good. It was chicken with some potatoes and some broccoli. But this is common, right? There are a lot of road shows at the Omni Hotel. There it is where it is, in part because they can book those kinds of road shows. I think that the investor interest is really, people are really curious about this thing. It's gotten so much attention, just people shaking their heads at the deal. When I talk to them about it, because, we've done a lot of reporting on the show, and I think that we've done more than, frankly, a lot of the investors. There's a certain group of institutional investors, and this is how they learn about deals. And this is sort of maybe not the beginning of their investing process, or maybe it is, but they go to these lunches, they get their free lunch, they get their chicken dinner from Morgan Stanley, and they start to figure out if this is something they want to follow, whether it's long or on the short side.
And yet we're hearing that Groupon wasn't really answering a lot of questions. Ken, what are the challenging questions that some of these investors want answers to?
Well, I think as you look forward, you have to imagine that this business is ultimately going to change from what it currently is. I think currently it's a very Salesforce intensive model, and ultimately they want to be a platform, something much more akin to a Google or an Amazon that's self-serve in terms of their marketplace. And I don't know that they've really demonstrated that they have kind of the technology chops to kind of go head to head with those other players. So I think that those are the big questions that investors have. Assuming that they're not able to make that transition, then you're not going to see that same margin scalability, and I think it's going to be difficult to support the current valuation.
Paul, your thoughts on that? We're already hearing a lot of investor fatigue, merchant fatigue out there, user fatigue out there with Groupon. Would a self-serve service be any different?
Yeah, pundit fatigue too. No, I don't think it would be any different. But it's absolutely crucial, as you saw, the lengths to which the company was forced to go to cut marketing expenditures to prove that in some alternate universe it could be a platform if it had smaller marketing spending. The trouble is, of course, you saw this rapid deceleration in the top line, the sales number for the business, which is driving, I think, many of the questions people have, which was, hey, wait a minute, as soon as you cut marketing spend, this business growth shrinks to zero. How is it, again, I'm supposed to pay up for a business that requires this capital expenditure to grow? And that's the fundamental tension as it stands as a business today, as opposed to what it might be 3 years out.
Cory, is Groupon going public right now because it wants to, or because it needs to? It needs the capital.
Well, it needs to, right? They've got $250 million in cash. I think their payables is more than twice that. But wait, I want to bring back what Ken said. Ken put out this report this morning, was just talking about the idea that if Groupon had lower marketing costs, was in more places, had higher margins, it would be worth the valuation. They're saying, basically, Ken, it sounds like what you're saying is if these guys had a different business model, they'd be worth billions. The same is true about me. What they've got right now isn't working. Is that what you're saying?
No. Well, what I'm saying is they have relationships with merchants. They also have share in terms of the vouchers served. And I think assuming that they can leverage that 2/3 share that they have to ultimately drive higher yield for merchants who are using its platform, then I do believe it would have certain network effects and barriers to entry. I think its current model, though, isn't taking advantage of all those offers that are delivered, and they haven't really shown that they're able to sort of transition into a model that can really leverage that data yet, I think, as Amazon or Google have more clearly demonstrated. So I give them a certain amount of credit, I think, in terms of the relationships that they have and the share, and that they'll be able to make that transition. But I admit that I think on an operating performance basis, that the amount of the billings per market or headcount per market, in terms of reductions that would be required to sort of get to those levels will be pretty severe.
Paul, let's start with you. Is Groupon a technology company or is it a sales company?
No, it's a sales company. I mean, it's possible it could turn into a platform company, a technology company, but there's the old line that, if my aunt grew wheels, she'd be a bicycle. That doesn't mean she ever will. So it could turn into a technology platform. It just isn't, and it isn't likely to happen very quickly.
So Ken, given, Paul's thought there that Groupon is more of a sales company, can it scale as quickly as a Facebook or a Google without the scaling ability that comes with being a technology company?
Well, I think that's the key question. I think that, it's going to require users to become, more accustomed to basically going to Groupon as kind of their source to find. I think at the basis of what we're talking about is a very sort of core commercial search functionality, which I think, Amazon and Google know very well. So, to the extent that merchants will ultimately look to Groupon to be a platform to reach this audience, and users will grow accustomed to using Groupon to find things that they want to, buy, see, where they want to eat. I think that's a big question, and I think that'll require technology and kind of a data handling that they haven't demonstrated yet.
Now, Cory, obviously, we're hearing a lot of negative sentiment about Groupon out there, but the bottom line is Groupon is still the leader in the daily deals business. I mean, what does Groupon become ultimately? Does it lose that lead?
Well, I think that's really intriguing. Ken's note this morning talked about where margins might stabilize for the merchants. That is, presently they take 50 cents on the dollar on average, that might get down to 20% because of 20 cents on the dollar once competition sort of demands that. I think it will be interesting to see how it evolves and, frankly, how long of a runway it can get itself by doing an IPO if, in fact, they get this done, which is by no means a certain thing right here. I think it's also really interesting here that, yes, they've generated a ton of revenue. I mean, from a revenue basis, this is a really big company. But Kedrosky had this great Warren Buffett-like line. Yes, I put Buffett and Kedrosky in the same sentence at the same time, where a couple of months ago when we first talked about this, he says, yeah, if you sell a dollar for 50 cents, you're really profitable. And that's still the problem with Groupon.
Yeah.
Now, let's talk about the way technology is trading right now. Paul, you made the point earlier that Groupon is not necessarily a technology company, but it certainly gets lumped in with the other tech IPOs. How do you think Groupon is going to affect other upcoming technology IPOs?
Oh, I think there's no question it'll have a halo effect, and Cory kind of alluded to this earlier with talking about if Morgan Stanley can bring this thing out, they can bring anything public, and there's some very attractive deals looking to come public. There's Zynga obviously sitting in the wings right behind this. Then sometime in 2012, there's Facebook out there. So there's some big names, but there's an awful lot of smaller companies that would all love to come public, or at least their venture capital backers would love to get them out and get some liquidity. And seeing the yeoman efforts being made here to bring these guys public is going to have a huge sucking effect in terms of bringing out a giant amount of inventory into the pipeline and then hopefully onto the public markets if the underwriters have their way. So this is really a test case of what can be brought and at what cost and to whom.
Now, Ken, we're hearing a lot of excitement about these upcoming tech IPOs, but tech more broadly seems to be relatively cheap right now. With all of this excitement, why are the tech companies trading so low?
Well, I think there's maybe a certain amount of uncertainty in the marketplace. I think that you have a lot of trends converging right now, and you have Google, it's been traditionally in the search business, very high margin. Now they've bought Motorola. They're going further into the hardware business. This is lower margin. I think that you haven't seen it so much on the Amazon side, but I think that has largely to do because of the size of the addressable market. But I think that there is a concern that you're seeing so many trends kind of come into play here that I think people's visibility a few years out, I think, is somewhat in question.
All right. Ken Sena of Evercore Partners, Paul Kedrosky, our Bloomberg contributor down in San Diego. Thank you all for joining us here on Bloomberg West.